Hello and welcome to this month's market update. I'm joined by Philip Naylor, a member of our capital markets and asset allocation team. Welcome, Phil.
Hey, Wei, how you going?
I'm very good, thank you. So over the course of July, there has been evidence of economic recovery and equities have now rebounded back to pre-COVID levels with emerging markets outperforming developed markets. What is your takeaway from this? Do you think equities are likely to continue to rally?
Yeah, well, I guess it's the million-dollar question, isn't it? Certainly has been an interesting one with equities. I think from a macro perspective, clearly with COVID, things are still pretty fragile. I think from a global perspective, when you saw countries like the US and Europe a few months ago start to contain new cases, if you look at the global data, that was still showing that was essentially more than offset by continued increase in terms of testing and then new case numbers in a lot of the emerging market economies. I think clearly from a global sense in COVID, we're still very much in the kind of first wave and it's essentially quite fragile. But against that backdrop, equities have been performing pretty well. In the case of the US, markets reaching new highs. In Australia, markets haven't got to that high level, but still have rebounded very strongly. There's probably a couple of things to unpack there in terms of why that's been the case and what might happen looking forward. I guess the first is just the impact of the stimulus measures, in particular monetary policy, and the effects that's having. When we're in a world of really low interest rates, it is possible that can boost assets like equities to even higher. That's certainly been the case when you look back all the way back to the 1980s. There's been a world where bond yields have been falling, and that's generally coincided with higher and higher equity valuations. So that's certainly one aspect affecting equities. The other one is, particularly in the case of the US, there's a sense that perhaps some of these US tech stocks can sort of get all the benefits of low interest rates, but they could be somewhat immune to the economic fallout from COVID. And I guess that in some ways is true to the extent that businesses keep diverting more and more of their advertising spend to online avenues. So that would certainly help Facebook. And as us as consumers, if we keep going and shopping online in droves, that's certainly going to help companies like Amazon. So I guess they're the issues that investors are trying to grapple with in terms of trying to match up what's happening in the economy, which things are still pretty pessimistic with the equities that have been rebounding pretty strongly.
Yeah, so you mentioned that the performance of the Australian equity market has been lackluster, but iron ore prices have held up and the Aussie dollar has appreciated. Looking ahead, could you see performance start to pick up from here?
Yeah, it's definitely it's possible that when you look, as I said, that I think part of the story really in the difference in why countries like the US or Chinese equities have kind of gone to new highs and Australia hasn't. I think part of that story is really just the composition differences in those stock market indices. So we know that in Australia we have less of those tech stocks that we've talked about, the benefits that they could potentially get compared to say the US. And then in Australia, obviously, we've got a much higher weighting in terms of mining stocks, which were hit particularly hard when we saw oil prices drop to very low levels. But as you said, the rebound in iron ore, which in part has been driven by supply disruptions in Brazil, that's probably helping in the short term for those stocks. But then the other big thing that we have is obviously a big weight in terms of financials and banks. And then, it doesn't matter whether you're looking here in Australia or overseas, when you look generally, when you get an environment of lower interest rates or interest rates going to very low levels, that does seem to hamper banks' ability to make profits. So that's certainly been one issue that's weighing on bank stocks here, which in part explains that difference between what you're seeing in some overseas equity markets and what's happening here in Australia.
Thanks for that, Phil. On the commodities front, oil prices have now largely stabilized, but gold was probably the biggest story of the month. What's been driving the rush to gold?
Yeah, well, it's certainly got people talking. Gold's up 40% in a year. So when you see an asset class that returns big returns like that gets people talking and wanting to know why. I think with gold, there's a couple of different things going on. The first is, as I said, like we're in a world of really low interest rates and bond yields have been falling. And when you get that sort of environment, the opportunity cost of being out of something like fixed income and into an asset class like gold that has no income stream, and you get really low interest rates, that opportunity cost is very low. So that will naturally help support assets like gold. And then the other one is inflation. So we know with the global recession, really near-term price pressures are going to be very low. But investors are starting to ask the question then, more medium-term outlook, what is the effect of all this stimulus that's being enacted by governments? What will that do to inflation? So I think to the extent that investors are starting to get a bit more cautious that inflation could be a bit higher in the long term, that's also supporting gold. But I guess when it comes to markets, I think it's today's hero can be tomorrow's villain. So I think as an investor, you'd want to be very cautious about expecting those sort of really high returns out of an asset class perennially. So the outlook for gold is maybe not as rosy as it has been in more recent times.
Thank you very much for that great update, Phil, and thank you for joining us.